Hey everybody, welcome to this free edition, this holiday weekend edition of our Trader User Group Weekly Roundup for the trading week ending July 2nd, 2021. I'm Preston Brent, and thanks for tuning in. This week's theme, are there any cracks yet? I mean, the market's just amazing right now. The U.S. market's had a really great week. Next week's going to be a holiday shortened week. As just a reminder, this is Independence weekend for the U.S. Independence Day is tomorrow, Sunday. Monday will be a full day off for everybody. That's American traders, for those that are following the American markets as well. The futures market will open Sunday evening, normal time, 6 p.m. Eastern Standard, and close on Monday around noon, and then open back up Monday evening. But the equity markets are all closed. The bond markets are also closed. Really interesting week, guys. I mean, very strong, very interesting week. So let's just kind of take a look at where everything kind of lined up from a market performance perspective. Let's take a look at the index performance. You can see here, just about everybody was in the green with the exception of the Russell. Up very strong for the week. Year to date, everybody is very strong. The Russell is still leading the way. The S&P is catching up. I mean, the S&P, my goodness. We saw the Russell 1000 growth, however, the small component of the Russell 2000, the 1000 growth, has had 8 weeks in a row of gains. The S&P's Friday close, where we closed this Friday, it was the seventh in a row all-time high. That's the longest daily consecutive all-time high streak since 1997, going way back. And this first half-year gain was the best since 2019 and the second best since 1998. So again, markets are on fire right now, but we've got to be careful. As I tell our members, I am still looking for a pullback sometime in July, August timeframe. Now, last summer, if you guys remember, I called the same thing and I was about 8 weeks late. We had a 10% pullback, but came in September last year. So, but I still believe we do need a pullback. We haven't had a healthy pullback since September of last year. Speaking of September, where the markets pulled back 10%, the Nasdaq was a little bit stronger than that. Okay. You can also see that the forward PE ratio is at 22.65, 10-year Treasury 1.31. The spread between the 10-year Treasury and the dividend yield is about 8 basis points. So it's getting tighter and tighter, which continues to funnel money into the equity markets. I mean, just really big time. You can also see the current VIX closed the week at 1507. The prior week it was at 1562. So down just a little bit for the week. But all in all, very strong week. The best performing sector was, I guess it was utilities. Technology. I've got energy up there, but it actually was technology. Energy, though, is the best performing sector for the year so far, 47.32. Utilities still in the green, but bringing up the rear for the year at 3.67. But the worst sector this week was utilities at 1% underwater, as you can see. Now, if we talk a little bit about some of the economic performance driving some of this data, this past Friday we got the Labor Department where employers added 850,000 non-farm jobs. So that kind of moved the markets, had a good strong finish on Friday, where we moved up, really nicely on the week. The SPX finished up a little over 32.4 points on Friday. As I said, the S&P's Friday's close was its seventh all-time high in a row. So that's just, winning streak going back to 97. So very strong. We also saw the jobless claims um, actually coming in at 850,000, well above the consensus estimate, as I said. The jobless claims fell more than expected. We're at a pandemic era low of 364,000. We did get the ISM gauge of factory activity. It fell just a bit, but still healthy because it's over 50. And the biggest surprise, or one of the big surprises, pending home sales. Everybody's expecting it to pull back, but it jumped 8% in May. So that was pretty strong. And of course, if we look at treasury markets, interest rates continue to confound a lot of traders, right? U.S. Treasury yields decreased most of the week. particularly going out on the yield curve, out 30 years or so. Some analysts are attributing this past week, even with a strong index performance, to some month-end rebalancing. Because remember, we're coming into the end of the quarter and then going into July. So we got month-end rebalancing, and the Fed buying longer-dated treasuries. It kind of drove the yields just a little bit. Now, of course, if we come over to Europe, let's take a look at the index performance. You can see just about everybody for the week was in the red. The only exception was the DAX, that's the German index. Everybody's still solidly in the green year to date, pretty much everywhere. China is having a hard time of it. They had a very bad week, 2.4% underwater. They're just barely hanging on year to date, just above break even. Now, they started cutting a lot of their economic stimulus, a lot of the stimulus that China is putting in the country earlier, much earlier than everybody else. They almost went into a bear market this year, believe it or not. So that's why China is really kind of underperforming. But getting back to the European markets, we're starting to see some inflationary pressures come into there as well. But like the U.S. markets, core Eurozone government bonds are falling. Um, and we're getting, Europe is more sensitive than the U.S. It seems like the COVID shutdowns, openings again. So they're having that Delta variant, which, in my mind, I'm just saying, leave it alone. There's always going to be a variant coming out, but, it's Europe for you. We don't want to be like those guys, but that's what's going on. Their consumer prices fell to 1.9% in June from 2% in May. So, but it's still a lot higher. Inflation over in Europe's ticked up 6 months in a row, and it's near the ECB target of 2%. So remember, it closed at 2% in May, then it ticked back just a little bit in June to 1.9. But a lot of that's due to the closing of a lot of companies in Europe because of some of these variants to the COVID crisis, which is just going to wreak havoc on their economy much longer than I think is necessary. The jobless rate in Europe also fell a little bit to a seasonally adjusted 7.9, right, from 8.1 in April. So, and we're getting the Eurozone PMI data. It came in at 63.4 in June. So that's a pretty good high reading. Anything, as you guys know, over 50 is an expansion. So Europe is looking pretty good, really, but they just keep stepping on their own feet by shutting things down again. And then if we go over to China, they're really having a harder time of it. Really, the Shanghai Composite, posted a weekly loss. It was and on Friday they had the biggest one-day drop since March of this year. Their June manufacturing data did meet expectations, but it came in a little bit weaker than expected. So keep in mind, China's the second largest economy globally. We got to watch them very closely. So that's kind of where we're sitting right now in the markets. Very strong week in the U.S., finishing at all-time highs for both the Nasdaq and the S&P. The Russell has not made all-time highs. I'll show you the charts. The Russell growth, but strong 7 weeks in a row. I'm going to switch the screen over here real quick and just kind of go through some quick charts for you guys so you get an idea. Members, we're not going to have our weekly market watch this tomorrow evening, Sunday evening. It is going to be July the 4th. I'll be out there on the balcony watching fireworks over the beach. So that's what I'm going to be doing, maybe having a tall, cold beer. But outside of that, everybody should just enjoy the day. For those markets that are open, the volume will be very light. We're coming into the summer months. What you see on the screen here is the S&P E-mini futures. You can see here we made that all-time high on Friday. Just had a good strong move up almost to 43.50. Now, if you guys remember, I said the top in the markets this year would be between 41 and 4,300. And now I'm seeing analysts, and even I will probably look at this and say that I could see it actually running up to 44.50, believe it or not. But I am still on track in the next couple of months of seeing at least a 7 to 12% pullback. Keep in mind, we've had 6 pullbacks since the March 23rd pandemic low last year. And of those 6, they've averaged 7.5%. We haven't had a pullback really since September of last year. So we are due. Normally, we get at least a 5 to 6% pullback about every 4 months. So we're gonna see something here. Now, keep in mind we got earnings kicking off in another couple of weeks as well, and then we got the Fed's meeting in July. Then they got their Jackson Hole, Wyoming meeting where all the mokey mokes meet. That would be the Bank of Japan and the U.S. Fed, and we're going to get the Bank of England. We're probably going to get the ECB. All the muckety mucks are going to be meeting there, and they typically use that meeting as an annual meeting to talk about where they're going to go with the economy. So I think it's a good placeholder to start talking about reducing tapering, and that could also spur some selling. That'll be about the third week in August. So we've just got a lot of little ifs out there, a lot of potential cracks in the overpass. I guess it could really set the market in a flame. So let's just take a look at where we're sitting right now. You can see the 50 EMA and the 200 EMA both got an upward vector to it. Uh, for our members, I was pointing them in the right direction based on how we reacted to the 50 EMA back here on the 21st of June. And I said it's probably going to, if we beat that, we're probably going to run up, make new all-time highs, which we did, because back then the all-time high was around 4260, and I said we're probably going to run to 4300, and we actually overshot it by a pretty good little bit. But it was a easy tell on the markets based on the way we reacted to the 50 EMA. So now I think it's going to get a little bit harder slogging. We could come back and test a 4,300 very easily, and then we're going to look at where earnings are. Keep in mind this earnings season Q2 is forecast to come in very strong, very strong. So, but the markets know that. So what the markets are going to be paying attention to, price action is going to be looking at the forward guidance for Q3, Q4, and Q1 of next year. If it's not coming in to suit the PE ratios and the valuations, we're going to see a revalue on U.S. shares, and you're going to see it come back, right, to a level that makes sense. You can see down here, I've got this green line, that's 0.236 fib node. That is a good pullback point. That represents the pivot point from the pandemic low to the post-pandemic high up here of 43.47. So that would be where I would expect a little bit of a pullback. We may not get it that far. If we look at the distance and just kind of what that would measure out to, that is about 11, maybe 12, 11.5%. So I could see it's coming down there. Notice the 200 EMA, it's moving up from there. It's got an upward vector, but the 200 EMA takes us right down to about 11.4%, right? And the 50 EMA, which I can almost assure you we're going to test again, is about 3.5%, about a 150 point move. We can do that in just a day, actually, or maybe 2 days. Boom, when we test it again. So use as a watchword how we test the 50 EMA. That'll give you a clue as to whether we're going to go lower or it's going to bounce up again. The other one that you need to watch very closely is the Dow Jones transports. All right, look at the transports right now. We broke the 50 EMA. The last all-time high was a lot earlier, May 10th, right? And then it just fell off the table. Now we held above and below, above and below. We did this little rain dance for 5 days around the 50 EMA, red, green, red, green, red, and then we finally broke. Now we're doing the requisite, let's retest the 50 EMA, but we're sitting right on it. If we fail this retest, then the odds favor us to come down and take out that little low right there. And if that low does not hold, it's going to drag the rest of the market down. This is the Dow Jones transports tend to follow the rest of the market. You can see the 200 EMA sitting down here at 236. All right. So that could put a little bit of a fly in the ointment for the rest of the markets. Now, if we look at Bitcoin, keep in mind it is not a hedge, not right now. And I think Bitcoin is going to go lower. Now, I was calling for it to go lower back over here. I said this was a trap, a bull trap. We rolled over. And then I said we're probably going to come down to the low 40s, high 30s. And you can see we kind of sat here. And then we've blown right through the 50% fib node. And now we're testing this node down here around 298, 29,800 and some change. I think we're going to go a little bit lower, possibly down to the 25,000 to 27,000. We're going to start to consolidate, and then we're going to start a long, slow jog higher. Okay. Right now, every rally is a bull trap, and you just want to sell the rally until we can get back up over this key point right here around 41,000, 42,000. We need to get back some elevation there. Otherwise, we're running sideways to down. Okay. So these are just a couple of ones that I wanted you to pay attention to. One other one here. This is the FANG index. It's the one that I created here in eSignal. It's Microsoft, Facebook, Apple, Netflix, Google, and Amazon. Of all these, my favorite is Google and then Microsoft. But notice here, we finally broke out. We were trailing the rest of the market when value stocks were taking off and growth was not liked or loved. Now, once we broke above the 50 EMA and we got into this run, we cleared this little zone here. We made new all-time highs this Friday in this index, this custom index. Now, let's watch this very closely because if we do start to get the markets rolling over, we will see technology get the brunt of it. If you guys remember in Q1, Amazon, Google, all of them blew out their earnings. They're going to blow them out even more in Q2, but their guidance was not as good, and every one of them sold off. Every single one, including Apple. So let's watch these for a clue to see how they're going to react in this earnings cycle. All right, very important. If we come down here to volatility, you can see vol closed out the week at 1507. We're right down here. We're still in the lower part of the yellow zone. But down here, we're just ripe for a move higher. Hedges are a little bit cheaper right now. And it's better to buy a hedge and get hedged in your portfolio. If you don't have any hedge and you're all long, you're hanging out there in a wire. Don't do it. All right. And of course, if we look at the bond market, interest rates continue to go down. Bonds are continuing to run up. Ideally, I'd like to see the bonds come up and test the 200 EMA, and then I'm going to go short the bond market if we can get that high of a move on it. My longer term forecast for bonds, however, is down to the 150 and 16 ticks. So let's call it 150. So we got this 3, 4, 5 pattern, but this could be an extended foreleg, which can be ugly at times. And if we let me just move that off the floor here so that you can see it. So you can see the pattern here. We're making higher highs and higher lows. I think that's going to come to an end here shortly. Let's see how it goes and fares through earnings cycle. I think it's going to put more pressure on the Feds to raise the rates. And I think it's going to roll the 30-year bond right back over. If it goes back below the 50 EMA, then that would be a definite short. And you could trade it either with TLT or TBT. If we come down, excuse me, let's look at gold. We're going to consolidate here. All right, hang on one second, guys. Sorry, guys. You can see gold's going to be consolidating here. I think it's going to slowly go back up as we go into the second half of the year, meaning I think gold's going to be higher from where it is now in the second half of the year. I think it's really going to take off in 22 going into 2023. All right. Longer term is long. Right now we're in chop. Same thing with silver. Let's look at the oil. I'm telling our members here, OPEC's having an issue. You can see here, let me just move it up. We actually hit, and WTI oil futures 76.22. I think we're going to come back down and test the 50 EMA before we go much higher. So playing a fade here makes a lot of sense to me. Okay. Now there's a big drought going on right now, and you can play that with wheat. I think wheat, even though it came down here, we're finding a support area here. Remember, it took off like the rest of the commodities here. I think it's going to find some support and possibly move higher. All right, you can play wheat futures, or you can play WEAT, which is an ETF that plays it. So these are just a couple that I've got here. Members, we'll have our next session, our pre-market trader session on Wednesday morning. I'm going to see you guys in our chat room on Tuesday. We got a lot of activity going on, and we want to follow it very closely with some of our trades. We just put on some new trades, got some profits in some that we may want to be shutting down here shortly, especially NVIDIA. It's been having a nice run. All right, everybody, have a great July the 4th weekend for those of you that celebrate, especially here in the American markets. Otherwise, I will see everybody else on our weekly roundup the following week. Members, I will see you Tuesday morning. If you're not a member, I highly encourage you to come in. We're having fun. It's going to be a fun second half of this year. It's going to be wild and woolly at points. All right, everybody, have a great weekend. Thanks. Ciao.